Hi folks, welcome to this video that asks you to prepare a consolidated balance sheet at acquisition date under both parent company extension and entity theories. So first thing we want to do is just point out with respect to the parent company extension theory, it has a different way of calculating goodwill that will go on the consolidated balance sheet and NCI. So under PCE, the goodwill on the consolidated balance sheet is only P's share of the goodwill you calculate, and NCI takes in the sub's book value plus the increments and decrements of the sub times NCI's share. So we're going to talk a little bit about how this is different, okay, under both methods. And again, don't forget, we're only talking at acquisition. So NCI at acquisition is calculated using the sub's book value plus any increments and decrements that were assessed when we did our book and fair value comparisons. Add those together and then multiplied by the NCI share. As we go through, we'll be pointing out these differences to you in the calculation of goodwill and NCI under both cases. But first, let's look at the data. Here we have our data for Puff and Smoke, Puff being the parent, Smoke being the sub. And we see that at January 1x2, Puff purchased 60% of the outstanding common or voting shares of Smoke for $500,000 in cash, and the balance sheets of both companies are shown below immediately after the acquisition. So the $500,000 is already out of that figure. So we have Puff, the parent's carrying values, and the carrying or book values of Smoke. And these are the fair values in our next column. So now, with these figures in mind, we want you to calculate the acquisition differential, goodwill, and the value of NCI at acquisition date. We're going to do it first under the parent company extension theory. So we know we paid 60%, or we bought 60% of the outstanding voting shares, and that cost us $500,000. But the fact of the matter is we control by owning less than 100%. So what's the implied value of what it would have cost us to buy 100% of the investment? Even though we don't, because we have control. We control the investment, but we only control with 60%. So we're anxious to find out what is the implied value of 100%. Okay, so this method assumes, using this method to calculate the goodwill, assumes that we would have paid $833,333. But as we've read, the parent company extension theorists don't support that method. They don't support a linear assumption. They don't believe that you would have paid $833,333 to get a 100% share just because you paid $500,000 to get a 60% share. And that is what underlies the difference between the entity theory and the parent company extension theory. So with that difference in mind, we're going to compare this $833,333 to what we now control of that sub, which is its common shares and retained earnings, or its net asset position. Now in the text, you can also use assets less liabilities of the sub, which we have here, assets less the liabilities here, 30 and 400,000, right? And you can also get 630,000. You'll find in some questions, depending on the question, they don't always give you the assets and liabilities, depending on what they ask you to do with the question. So I always like to show students both ways. Calculating the book value of net assets that the parent now controls using the net equity, which is common shares plus retained earnings. That gives us 630,000 as well. So the acquisition differential is 203,333. So far, both methods, parent company extension theory and entity theory, are the same. So we have this acquisition differential. Now we have to allocate it. Some of it's going to get allocated to any fair value increments or decrements that were assessed by the parent, and anything that remains unallocated will go to goodwill. So in our case, we know that the inventory, when we compare it, the carrying to the fair value, we see the inventory was booked by Smoke at $20,000 or $150,000, but the parent thought it was worth $175,000. We also see that with the current asset, with the capital assets, we see at net, Smoke has them booked at $875,000. And the fair value is $950,000. So we have a $75,000 increment on the capital assets at net, and we have a $25,000 increment that's been assessed by the parents on the inventory. So those are both pieces that we paid extra to get. So in comparison to the acquisition differential, we've already allocated $100,000 of that. So we would calculate at this point $103,333. Now this would be what it is under the entity theory, and we'll get to that in a moment. So under the entity theory, we would have that. However, what we said is that this number is being compared to this number to come up with the acquisition differential, from which you deduct your increments and decrements to get goodwill. The parent company extension theorists don't support that view. They don't agree with this number, right? So they would say, well, whatever goodwill you calculate, you only take your share onto the consolidated balance sheet. So in other words, NCI is not allocated its share of goodwill under the parent company extension theory. So I put it down here as less goodwill not allocated to non-controlling interest, because that's kind of the way the text describes it, that there's this goodwill that doesn't get allocated to the NCI. But the bottom line is that 60% goes to the consolidated balance sheet. So this $62,000 is really 60% of this rounded, all right, to the nearest dollar. So again, under the parent company extension theory, they would not allocate to NCI its 40% share of a number, 103,333, whereby they don't agree with its calculation. They don't agree with this linear relationship that makes us get this 103,333. They don't agree with that. So we only put on the consolidated balance sheet the parent's share of goodwill, which is $62,000. What's non-controlling interest going to be? Well, normally, under the entity theory, we would take non-controlling interest on the balance sheet as 40% of the implied value of 100%. We don't do that under the parent company extension theory because they don't believe this number. They don't believe that to buy 100% would have cost you $833,333 just because 60% cost you $500,000. They don't agree with that linear relationship. They don't see it that way. So those theorists would say that NCI in the balance sheet is not going to be equal to 40% of this. They would take 40% of the book value plus the fair value increments and decrements. So they take 40% of the fair value plus the increments and decrements, okay, and multiply that by 40% to get $292,000. So this is a critical difference. You'll find that under the parent company extension theory, on the consolidated balance sheet, we only show the parent's share of goodwill. And on the NCI side, we calculate NCI as the fair value of net identifiable assets, which is the book value and plus the fair value increments and decrements at NCI share, and that's $292. Whereas under the entity theory, as I said up here, the entity theory does support this linear relationship. So they would say, well, that's your goodwill, and your NCI is getting 40% of that, which is going to be $333,333. So again, different numbers, which means your balance sheet will balance to something different. So now, with that theory explained, let's talk a little bit about what the balance sheet would look like under the parent company extension theory. So, if we did that, you have to remember that regardless of whether we're using PCE or entity theory, we follow the acquisition method under IFRS. And that means that when you're preparing the consolidated balance sheet, the parent prepares it by taking its carrying values from its balance sheet and adding to it the sub's fair values, which is basically the book value plus any increments and decrements that were assessed on the sub's assets and liabilities. And we already know we had two increments. We had an increment for inventory and an increment for the capital assets, right? So we already know that. So with that in mind, that theory in mind, under the parent company extension theory, if we were preparing the consolidated balance sheet at January 1 X2, after they became related, under the direct method, so I use the direct method here, that's the method that your text uses. You'll notice it doesn't use a worksheet very much, if at all. They don't use the worksheet. And again, I guess it's because they don't know if a lot of faculty members will be using Excel or whatever, right? They don't know what you're going to be using in your classroom, so they don't use the worksheet. They use the direct method. So what we do is we take the cash of the parent and add to it the cash of the sub to get $215,000 in cash consolidated. Add the receivables of the parent, add the sub's receivables to get consolidated receivables of $95,000. But don't forget, we're using the acquisition method. So it says to get inventory, you're going to take the carrying value of the parent's inventory plus the carrying value of the subs plus the fair value increment. So this amount here together, $175,000, that is the fair value, right? The only reason I've separated out the increment, the only reason that I've displayed this differently than perhaps your text does at this point is because I know that later on in this course, you're going to be amortizing these increments. And we'll explain that when we get there. But you will be amortizing any increments and decrements that are assessed at acquisition. So inventory is an increment, and the $75,000 is also an increment. You're going to learn when we get into further chapters that when you have intercompany sales of assets and you have to prepare consolidated statements down the road, you're going to have other things that are going to affect these types of accounts, like inventory and capital assets. And the amortization of these increments is one of them. But bear in mind, I am still using the acquisition method that looks at taking Puff's carrying value, which is the first number here. And for your inventory, it's $1.65 million, plus the fair value, which is equal to the book value, plus the fair value increment of the sub. So these two together, that $175,000, is Smoke's fair value. But I've only separated it up because I want to get you used to this presentation, even though the text may not use it at this point, because I think it's important that you realize that these increments are going to be amortized. So I want to make sure that they are spotlighted in everything we do under the direct method so you don't forget they're there. Likewise, with the capital assets, $950,000 is the fair value of Smoke's capital assets, but I'm separating out the increment because it's going to be amortized later. Notice here under PCE, Goodwill is not $103,333. It's only 60% of that, or the parent's share, which is what we calculated here, $62,000, right? So that's what we've got here, and you'll notice our total assets equal $5,297,000. With liabilities and equity, if you look at the liabilities, there were no fair value increments or decrements on the current liabilities or the long-term debt, so we just have long-term liabilities added together of $2.91 million. Now in the shareholders equity section, there are some things that I need to talk about that are particular to PCE and not. So first thing I want to say is that the common shares and the retained earnings that you will see on the consolidated balance sheet at acquisition are only those of the parent. Why? Because the consolidated statements, first of all, are being done for the parent's shareholders, right? So whoever Puff's shareholders are, they're looking at these consolidated statements. The NCI shareholders don't care because they're not shareholders in the parent, they're shareholders in the sub. The parent shareholders only want to see the common shares that P has. Therefore, they're the only ones that go on the consolidated statements, the consolidated statement of financial position or balance sheet. Notice the retained earnings are only the retained earnings of the parent as well. And here's the reason why. And this doesn't matter if you're using PCE or entity theory, it's the same thing. Whenever there's a business combination, all right, what we have here is the fact that if there are any retained earnings that the sub had that pre-existed this relationship it now has with the parent didn't have anything to do with earning that retained earnings that the sub had before they became related, so the parent does not pick up any of that on its consolidated balance sheet. So it only picks up its own. Later on, once they've been related for a year, 2 years, 5 years, 25 years, we're going to see that the parent will take its share of the post-acquisition retained earnings, or whatever retained earnings were earned by that sub since the date they became related. But that's a topic we'll get into in later chapters. But the idea here is that the common shares and the retained earnings are only those of the parent. We already discussed under PCE why we have 292,000, all right, and not 333,333 for NCI, because under parent company extension theory, don't forget NCI only gets allocated its percentage share of the fair value of the net identifiable assets of the sub, which is basically its book or carrying value at the date they became related, plus the fair value increments. Add those together and take 40% of it, and that's where you'll get 292,000. So again, we did that calculation for you right up here. All right, so now we've got our total shareholders equity calculated, and we can see we end up in a balanced position on the balance sheet. Now, let's turn our attention to the entity theory. And in fact, we've already done most of the work here. You'll notice that cash, accounts receivable, inventory, and capital assets are all the same under the entity theory as they are under PCE. Notice again, we've spotlighted the increments because we know in later chapters we're going to have to amortize them. The only difference here is goodwill, because don't forget, under the entity theory, these theorists agree that you can use a linear relationship. So again, if I only paid $500,000 for 60%, they think it's fine to assume that you would have paid $833,333 for a 100% ownership share, and they're going to allocate 40% of that, or $103,333, to goodwill. So if you look up here again, you'll notice where we did that. Goodwill is equal to 103,333, which is going to be I don't know if I put it in here now, times 0.40, right? Oops, sorry, wrong number. I'm in the wrong line here. Sorry, I got it confused with NCI. Scratch that. But anyway, goodwill here is what we calculated here before we before any deduction for anything not allocated to NCI. So in other words, we're going to take this 103,333 here for goodwill onto the entity theory based consolidated balance sheet. We also are going to take in there 40% of the implied value of 100%, okay, which is 333,333. So now, if we go down here into the entity theory and do the consolidated balance sheet, we'll see that we have goodwill of 103,333. We also find here that our current liabilities and long-term debt, nothing's changed there. But again, don't forget your common shares and retained earnings at the date they become related are only those of the parent. In fact, you'll find here that even in subsequent years, if you're doing consolidations years down the road, you're still only going to take in the consolidated balance sheet the common shares of the parent, because don't forget the consolidated statements are done for the benefit of the parent shareholders, not the sub-shareholders. So they want to see the common shares that are issued and outstanding to its shareholders, which is $1 million worth, right? Retained earnings here, again, is only the parents, because don't forget, there have been no earnings since the two parties have become related. So there's no post-acquisition retained earnings that the parent can lay claim to. Right? So we only take that of the parent. And then NCI, we've been through that. And again, sorry for that little mix-up earlier in the number, but I think you see that this is 40% of the implied value of 100%. So we're going to get total shareholders equity of $2,428,333. And when we add it to the long-term liabilities, you can see we wind up with a balanced position when we look at assets and liabilities and shareholders equity. So that concludes our video to demonstrate the differences between the parent company extension theory and the entity theory at acquisition, and how to prepare a consolidated balance sheet under both methods at acquisition. I hope you found the video helpful.